is insurance. And what it insures you against is everything that has to do with the confidence in which gold, the currency, is traded, the dollar. So all of this debt situations, even NASA spying on our allies, anything that can affect confidence in the U.S. dollar is hedged by, insured by gold. The combination is debt, dollar, gold. That's the influencing items that all come down to confidence. And confidence lost is a currency event. And hyperinflation, that which I expect, is not an event economic. It's an event of a currency losing confidence in a very short period of time. I believe that we are headed for hyperinflation, but it's important for the audience to understand that in every period where hyperinflation has been part and parcel of an economy, business was terrible. Everyone thinks that inflation has something to do with demand. They don't recognize that you can get a cost push effect, costs higher, because currencies go into disarray or lower. It's a currency event or loss of confidence in the dollar, which is going to result in a hyperinflation that gold will, without any doubt in my mind whatsoever, gold will insure the investor against. Very simply, how do we know that tomorrow isn't the day or the day after? We have so many things, Greg, wrong in the economy, so many holes in the dike, so many fingers stuck in the dike to try and keep it functioning, that any one of those would create, what, 10, 20, 30 events that could create significant loss of confidence? Nothing has changed. Things have gotten worse. Derivatives haven't gone away. They've grown. Debt hasn't gone away. It has gone up exponentially. There is no argument that says that the dollar is entering into a period of strength. The U.S. economy recovery is, at best, a straight line with a slight uptrend, but very slight, very fragile, very easily derailed, all of which affects confidence in the dollar. And gold is traded in the dollar. Loss of confidence by any matter can create a significant appreciation in gold. One, I believe, that when it comes about, will be brought about by the BRICS, and the price of gold, when it rises to the levels that I expect it to go to, will not fall more than 20% from those levels. I firmly believe that this takedown is very similar to the two periods in the 70s where gold dropped sharply and where the gold banks and interests that would be considered to be anti-gold made the most on the long side in the shortest period of time. Patterns, Greg, are people. So what you're saying is you're seeing the same action of people. And the answer is it is exactly the same. There's literally no question about it. The people who make the most money over the shortest period of time in the gold market are always the gold banks, normally identified with the desire to depreciate the price of gold. Because the exchange-traded funds don't necessarily own physical gold. In fact, they own gold in various derivative forms. And their lending of gold is controlled by the same entities that are associated with the depreciation of price. If an exchange was to not necessarily even go into default, let's say the COMEX goes to cash settlement because the COMEX inventory warehouse of gold, that which is capable, able, and ready for delivery, goes down to too low a number. Then you can expect the paper will come into question. And the question of paper is the question of the entire makeup. I'd say please read the prospectus before you feel the easy way, that is, of course, GLD, is the right way. It isn't. It's the wrong way. We're facing the annihilation of currency. We're facing the shift of America as the leading and most influential nation in the world to some form of a banana republic. We're facing, if we lost our strength in military, into being a second-rate country. In the banking industry, we're facing the possibility of a bail-in rather than a bail-out. On the individual level, if it wasn't for food stamps, we'd have long lines waiting for free food. If it wasn't for the fact that we educate every night when we watch the evening news or when we watch the financial TV, that education says to us that everything is okay, that a bad figure was unexpected, and that the spin that's put on even negative figures is a spin that would give you confidence that there should be some recovery in the future. The figures that we're looking at are figures that have been so massaged since 1970 that I would suggest it would be hard for inflationary indices to show inflation, that it would be very difficult for the normal indices we look at that tell us the condition of the economy to be seen, as Mr. Williams lets us see through his eyes, in the true condition they are. We are in a decelerating recovery, which by definition, economically, is an accelerating recession. Because legally, the money that they've deposited in banks, and this is the proper legal definition going back to 1850 in British law, but also in U.S. and Canadian law, it says very simply that if you put your money in a bank, you're an unsecured lender to that bank. Unsecured lender. That's not even as good as a bondholder. So the lenders are going to take the brunt, not the taxpayers, is how this will be packaged and sold. The problem is the lenders are the people watching this program. The lender is the person who holds what he thinks or she thinks is money in the bank. That is their asset. The moment you put the money in the bank, it is no longer your asset. It becomes an asset of the bank, and you become an unsecured lender. Now, the IMF proposed one more and very important criteria for the bail-in, the recent bail-in, and that was that retirement funds are to be nationalized. After that, we've had retirement funds nationalized in Russia, where the Russians say they will pay back someday, and we've had retirement income nationalized in Poland, where there has been no comment on any type of payback. The IMF seems to be the center for all change that's taking place. Ms. Lagarde seems to be the voice of change in the banking system, which will put the onus of rescuing banks on the depositors and the bondholders, that the onus now is on the people watching this to come up with the losses which if you'll take everything into consideration, in Cyprus, was a total of 83% of the assets, because when you get back worthless bank shares in a worthless bank corporation, you can't count that as money. And when you have a blocked deposit, which you've got to keep in the bank, you can't take out X percentage, you can't call that money. All you can call money is the check that is actually paid out to you. The loss was catastrophic. And the period of time when this was all being put into place in Cyprus, how did a farmer pay for the feed for his animals? How did a storekeeper pay his suppliers? How did a manufacturer pay his employees? How did a husband give a wife money to shop when all you could get was 200 euros? So the example of Cyprus, which we might have considered to be a small little Russian island pretending to be European, is in fact the blueprint for what we're going to experience here in the United States. Why bail-in is written right into the budget of the Canadians. It's written right into law in the Netherlands. It's written into law that most people haven't looked at. It's in white papers signed by the United States and the Bank of England, by the FDIC in the United States and the Bank of England. It's sitting there in BIS papers. People only have to look and see that they're in harm's way. Now, if you're in harm's way, how do you get out of it? You step to the left or to the right. So GOTS, or get out of the system, says if you sit there with your deposit in the bank, with all of your money with your broker, who are banks now in many cases, and these banks and institutions which took aid from the government, most likely the ones to blow up again, in fact do blow up, that your account, Greg, at your broker, your bank account at your bank, going to be hit for the amount of funds, and that it may even be extended to equity or